The U.S. economy is facing strong headwinds. The financial landscape is becoming increasingly turbulent, and the signs are hard to ignore. International allies have sold off a staggering $390 billion in U.S. Treasuries. This unprecedented move has sent shockwaves through the financial markets. This massive sell-off is a clear signal of waning confidence in the U.S. economy. Investors are worried. They are reacting to a combination of factors that have created a perfect storm of economic uncertainty. They see instability in U.S. economic policies. The unpredictability of these policies has made it difficult for investors to plan for the future. Former President Trump's controversial tariff plans are a major source of this unease. These tariffs have disrupted global trade and created friction with key economic partners. These tariffs, along with other policy decisions, have injected a significant degree of uncertainty into the global economic outlook. The ripple effects are being felt far and wide. The sell-off represents a significant shift in the global financial landscape. It indicates a loss of faith in the stability and reliability of U.S. financial instruments. For decades, U.S. Treasuries have been viewed as a safe haven asset. They were the go-to investment for those seeking security and stability. Investors around the world have flocked to these bonds. They have been a cornerstone of global investment portfolios. They are seen as a reliable store of value even during times of turmoil. This perception has been a key factor in their enduring popularity. However, the recent sell-off suggests that this perception is changing. Investors are re-evaluating their strategies in light of new economic realities. Investors are now questioning the long-term stability of the U.S. economy. They are concerned about the potential for future economic disruptions. The implications of this shift are far-reaching. A loss of confidence in U.S. Treasuries could have a domino effect on other financial markets. A decline in demand for U.S. Treasuries could lead to higher interest rates. This would have a direct impact on borrowing costs for both the government and private sector. This would make it more expensive for the U.S. government to borrow money. Higher borrowing costs could lead to increased budget deficits and reduced fiscal flexibility. It could also dampen economic growth. Businesses may find it more difficult to finance expansion plans, and consumers could face higher costs for loans and mortgages. Businesses and consumers may pull back on spending if interest rates rise. This reduction in spending could slow down economic activity and lead to a potential recession. This perfect storm of economic uncertainty has left policymakers and investors alike scrambling to assess the potential fallout. They are trying to navigate these turbulent waters with caution. The situation is further complicated by the looming threat of inflation. Rising prices could erode purchasing power and further strain the economy. The Federal Reserve has been gradually raising interest rates in an attempt to keep inflation in check. This delicate balancing act is becoming increasingly challenging. However, the recent sell-off in Treasuries could force the Fed to rethink its strategy. They may need to adopt a more aggressive approach to stabilize the market. The Fed may need to raise rates more aggressively than planned to shore up confidence in the U.S. economy. This could have significant implications for both domestic and global markets. This could have significant implications for economic growth. The path forward is fraught with challenges, and the stakes have never been higher. Former President Donald Trump's aggressive trade policies have been a major source of global economic uncertainty. His approach to international trade has been marked by a series of bold and controversial moves that have left both allies and adversaries scrambling to respond. His decision to impose tariffs on goods imported from China and other countries has sparked fears of a trade war. These tariffs, which were intended to protect American industries, have instead led to a series of retaliatory measures from other nations. These tariffs have already had a negative impact on businesses and consumers. Many companies have faced increased costs for raw materials and components, leading to higher prices for finished goods. Consumers, in turn, have felt the pinch as everyday items become more expensive. They have also disrupted global supply chains. The interconnected nature of modern manufacturing means that a disruption in one part of the world can have ripple effects across the globe. Factories have had to slow down or halt production due to delays in receiving necessary parts. The tariffs have raised prices for consumers and businesses, while also creating uncertainty for businesses that rely on imported goods. This uncertainty makes it difficult for companies to plan for the future, as they cannot predict how long the tariffs will last, or how severe their impact will be. Trump's tariffs are based on a flawed premise. He believes that by imposing these tariffs, he can force other countries to renegotiate trade deals in favor of the United States. However, this strategy has not yielded the desired results. He believes that the US is being taken advantage of in trade deals. This perspective has led to a more confrontational approach in international negotiations, straining relationships with key trading partners. He argues that tariffs are necessary to protect American jobs and businesses. While this may resonate with some domestic audiences, the broader economic implications suggest a more complex reality. However, economists widely agree that tariffs are harmful to the economy. They argue that tariffs disrupt the natural flow of trade, leading to inefficiencies and higher costs for everyone involved. They lead to higher prices, reduced competition, and slower economic growth. The long-term effects of these policies could be detrimental to the overall health of the global economy. The tariffs have also damaged relationships with key U.S. allies. Countries that have traditionally been strong partners of the United States now find themselves at odds with American trade policies. Countries like Canada, Mexico, and the European Union have retaliated with tariffs of their own. This tit-for-tat escalation has only served to deepen the divide and create further economic instability. This tit-for-tat escalation of trade barriers has created a climate of uncertainty and distrust. Businesses are hesitant to make long-term investments, fearing that the trade environment could change at any moment. It has made it more difficult for businesses to plan for the future. The unpredictability of trade policies means that companies must constantly adapt to new challenges, diverting resources away from growth and innovation. The tariffs are just one example of Trump's unorthodox approach to economic policy. His administration has pursued a range of measures that have upended traditional economic thinking. He has also implemented tax cuts and deregulation measures that have benefited wealthy individuals and corporations. These policies have been praised by some for stimulating economic growth but criticized by others for increasing inequality. However, these policies have come at the expense of the federal budget deficit, which has ballooned under his watch. The long-term consequences of this growing debt remain a significant concern for the future. The bond market is flashing warning signs. Bond yields have been rising sharply in recent months. This is a clear indication that investors are worried about the future. When investors are confident about the economy, they are willing to accept lower yields on bonds. However, when they are uncertain about the future, they demand higher yields to compensate for the risk. The 10-year U.S. Treasury note, a benchmark for global borrowing costs, has seen its yield climb to its highest level in years. This surge in yields is partly due to the massive sell-off of U.S. Treasuries by international investors. It is also being driven by concerns about rising inflation and the growing U.S. budget deficit. Rising bond yields have a ripple effect throughout the economy. They can lead to higher interest rates on mortgages, car loans, and other types of debt. This can make it more expensive for consumers and businesses to borrow money, which can slow economic growth. The Federal Reserve is closely monitoring the bond market. The Fed has been gradually raising interest rates to try to keep inflation in check. However, if bond yields continue to rise, the Fed may be forced to raise rates more aggressively than planned. This could further dampen economic growth. Section 4. The Federal Reserve's Balancing Act, Navigating Inflation and Growth. The Federal Reserve is facing a delicate balancing act. The U.S. Central Bank is tasked with maintaining price stability and promoting full employment. However, these two goals can sometimes be at odds with each other. The Fed must carefully navigate these competing objectives to avoid tipping the economy into recession or runaway inflation. The Fed's primary tool for managing the economy is the federal funds rate. This is the interest rate that banks charge each other for overnight loans. By raising or lowering this rate, the Fed can influence borrowing costs throughout the economy. The Fed lowered interest rates to near zero during the financial crisis of 2008 to 2009 to stimulate economic growth. These low rates have helped to fuel a decade-long economic expansion. However, they have also contributed to rising asset prices and concerns about inflation. The Fed began raising interest rates in 2015 as the economy strengthened. It has raised rates gradually since then to try to head off inflation without derailing economic growth. However, the recent sell-off in Treasuries and concerns about Trump's trade policies have complicated the Fed's calculus. Section 5. Currency Convulsions. The dollar's uncertain fate. The U.S. dollar, the world's reserve currency, has been on a roller coaster ride in recent months. Its value has seen significant fluctuations, causing both excitement and concern among investors and policymakers alike. The dollar has strengthened against other major currencies at times, reflecting confidence in the U.S. economy and its financial markets, only to weaken again amid renewed concerns about the U.S. economy. These concerns often stem from various economic indicators and geopolitical events that create uncertainty. This volatility in currency markets reflects the underlying uncertainty about the direction of the global economy. Traders and investors are constantly reacting to news and data, trying to predict the future movements of the dollar. A strong dollar can be both a blessing and a curse for the U.S. economy. While it can signal economic strength, it also has complex implications for trade and investment. On the one hand, it makes imported goods cheaper for U.S. consumers and businesses. This can help keep inflation low and increase purchasing power. On the other hand, it makes U.S. exports more expensive for buyers in other countries, which can reduce demand for American products abroad. This can hurt U.S. businesses that sell their products overseas, potentially leading to lower revenues and even job losses in export-driven industries. The dollar's recent volatility has been driven by a number of factors, each contributing to the complex dynamics of the currency markets, including concerns about Trump's trade policies, which have introduced new uncertainties and risks for international trade. The growing U.S. budget deficit, which raises questions about the long-term sustainability of U.S. fiscal policy, and the widening interest rate differential between the U.S. and other major economies. Higher interest rates in the U.S. attract foreign capital, boosting the dollar. The Federal Reserve's decision to start raising interest rates in 2015 has made the U.S. dollar more attractive to foreign investors seeking higher returns. This policy shift has had a significant impact on the currency's value. However, the recent sell-off in U.S. Treasuries and concerns about a potential trade war have weighed on the dollar. These factors create a complex and often contradictory set of pressures on the currency. If the dollar were to weaken significantly, it could have far-reaching consequences for the U.S. economy and beyond. It could lead to higher inflation in the U.S. as imported goods become more expensive. This would affect everything from consumer prices to business costs. It could also make it more difficult for the U.S. government to finance its budget deficit, as borrowing costs might rise, as foreign investors may be less willing to hold U.S. debt. This could lead to higher interest rates and further economic challenges.